Well, I view the tariff conversation as a bit of a distraction. The Americans are tired of being the global engine of growth. They're tired of running the global currency, which we have discovered is rather expensive. So Trump is trying to change this. He's trying to bury Bretton Woods once and for all, 75 years later. And as I've said to my readers, I said, look, this had to happen. No country can bear this burden forever. So I think what we're going to see is a slow migration back to a multilateral world where people are going to have probably more incentive to hold currencies of their major trading partners and neighbors than necessarily the dollar. The dollar will still be very important because it's so big. That's why people use it. The other currencies of the world, the next one would probably be the yen. Nobody's rushing to use the yen as a means of exchange, right? You and I have followed the markets for a long time. And the Japanese don't want that role. Neither do the Swiss, neither do the European community. So it's a job that finds you usually after a war. And what Donald Trump is saying is that we need fairness in our relations with other countries. We cannot always be the deficit nation. And I think that's obvious. I think it's a bit of an overreaction just from a market perspective if you're looking to do asset allocation. What I've been telling my readers is that this debate over tariffs is a bit of a distraction because Trump is doing this deliberately. He is using shock and awe to get our neighbors off the dime and come and talk to us. If you didn't put a gun to the head of the Europeans, they wouldn't respond. Well, they're responding. So Trump has kind of turned the card table over and he's saying, no, we're going to use different rules from now on. And that confuses and I think puts some fear into the minds of investors and whatnot. But the reality is, I think we should be looking at stocks and doing our homework. This is not necessarily a day where you want to be a buyer, but you want to be thinking about it because my financials are still expensive. We still have not retraced back to, the third quarter last year. Financials tore 50, 60, in some cases 70% in the second half of last year. That was not exactly normal, right? Remember, we were talking about rate cuts in September, and my lenders killed it. My lenders had an awesome quarter in the third quarter. Fourth quarter was okay. Now the first quarter of this year is kind of light, and I think you're going to see credit higher and volumes lower, which is, not a happy prediction, but we haven't had much growth in financials. You saw this with Jamie Dimon in the fourth quarter. If you go back and read his comments during the call, he said, there's no loan demand. I may have to give this money back to my shareholders in terms of higher stock repurchases. So that's kind of where we are. I think credit will be the big story this year. I think first and foremost, you have to remember that Democrats wrote the history of the United States over the last 100 years, especially after the New Deal. Coming out of World War II, the government had such a powerful influence on perception and news. All the media worked for the government coming out of World War II. And you had big banks, big corporations. They had all come together to defeat fascism. It was a national effort. So over time, I think conservatives have tried to refute some of the core assumptions in that narrative. But basically, if you look at the U.S., it was really the repudiation of gold and the seizure of private gold by FDR in 1933 that broke the link between money and inflation. In other words, that was what gave the government the ability to expand. Nixon is often remembered in the early 70s for closing the gold window, but that was kind of the last detail. So for me, I'd like to remind people in the book that we've had tariffs in this country going back to the inception of the Republic, and it was to protect us from European predatory competition. Now we have China, which is not much different. In fact, it's a little bit more concerning because they are a modern predatory mercantilist state. They're like Great Britain on steroids, and they are trying to essentially dominate the world in terms of market share. They don't play by the old Anglo-Saxon Western rules of commerce and fair dealing. So how do you have a relationship with a country like that? There's nothing wrong with tariffs if the other guy is putting tariffs or non-tariff barriers on your products. What Donald Trump is saying to Europeans is, let our products in, and then we'll talk. I don't know that the Europeans are ready for that, but I do know that this process is going to force the Europeans to come together. And the Ukraine and all the rest of it, that's a good thing. Germany has discarded their limit on debt issuance, which they had to do anyway. It's funny. See, look at the debate on tariffs. We keep coming back to this 19th century view that says it's going to be beggar thy neighbor, the race to the bottom, that kind of thing. No, in the modern era, it's about expanding your currency and attracting other nations to your market. Why do people use the dollar? Because it's big. Do they worry about us with a big deficit and big debt? Yeah, but they kind of like it. The fact that you can trade oil and large commodities in dollars without any problems is remarkable. And there's very few other currencies you could use for that, by the way. At the end of the year, there were only two consumer lenders in our surveillance group that we wrote about for our subscribers that were up, and that was Capital One and Synchrony. Synchrony is a very high spread, high risk consumer lender that runs white label programs for a number of big companies. They are kind of the bleeding edge of consumer finance. If you want to watch what's going on in the economy, you want to watch Synchrony. Now, they were up a little, but not catastrophically at all. Capital One was up a little, and the rest of them were all down. American Express, Ally, a whole host of other lenders. And you look at this and say, is this a head fake from the Fed? And I think the answer to that question is yes. You know, the Fed pushed the cost of credit down to zero in 2020 and 21 with low interest rates. You had auto loans in terms of loss at default going to zero. Auto prices, by the way, remember, used car prices went through the roof. And that meant you couldn't lose money. You just repossessed a car and sell it. So today, the market's normalizing. The worst asset class out there for banks right now in terms of loss severity is multifamily housing, incidentally, and the volume of default there is going up. But the two sectors I'm looking at right now are autos and credit cards. They're both slowly starting to show what we've been waiting for over a year. And I think that's going to affect financials because think of it this way, deposits aren't growing. Jamie Dimon was talking about this very eloquently. So we're not getting a lot of loan growth. And we're not seeing a lot of demand from customers of banks. They're just not demanding credit. So if credit costs go up in the first quarter, what happens to earnings? They go down because we don't have a lot of top line growth in the industry right now. The Fed has slowed the balance sheet reduction. That means bank deposits are going to grow a little bit. But I don't think it's going to be gangbusters by any means. Smaller urban properties that may have been rent controlled or rent stabilized. Think of Signature Bank. There's a whole pile of stuff that's sitting inside the FDIC's bank insurance fund left over from Signature Bank that the Biden administration didn't feel like selling. They will sell it, and they're not going to get much for it. The market indicators for those types of properties in New York City are at least 50 cents on the dollar below the last sale. And again, these are smaller properties. They're just too small. New York City, running a building has a certain cost. So you have to have X amount of square footage to make the building work. You know, we should be knocking down half of Manhattan and redeveloping it because those buildings were built by my ancestors, by the way. And it's time. They're 150 plus years old. They're too small. We need another Robert Moses. I hate to say he's a very controversial figure, but he got stuff done. And yet, you know, the capital, new money is pouring into New York. Everybody thinks it's, you know, it's great again. And we see overdevelopment all over the country. If you look above the average home price in the Southeast, Southwestern states, the amount of overbuilding, speculative overbuilding in both single family and multifamily properties is impressive. We're going to have to work it out. The indicators have been subdued and in part suppressed by monetary policy and also fiscal policy. There are hundreds of thousands of people sitting in various loan modification and forbearance programs in the FHA. Those are going to have to be resolved. You know, these are people who failed modifications 2 and 3 times. And during the Biden administration, the industry just kept them there. They would just advance principal and interest to the securities, and the loans would sit there in limbo. And obviously the issuer or the servicer would have to finance all of this, right? Now I think you're going to see the industry resolving more of these, and it's going to be painful. These are people who got kicked around during COVID, and they never came back. They never got back on track in terms of jobs and what have you. So the good news is that home prices are so strong that when somebody gets to a foreclosure, they sell the house and they give them the net proceeds, which is what they should do. That's a forced sale. And that's why the default numbers don't look so high. Well, FHA is reporting 11% delinquency right now as of the fourth quarter. I would tell you it's closer to 14 or 15. And that's a problem because at that level of delinquency, those portfolios are negative cash flow. And so if you're a big servicer, you have to be concerned about that. We're seeing considerable softening above that average $400,000 or $500,000 house. You're definitely seeing the market slow down. Or the new stuff will flip to rentals. When you see them starting to push rentals instead of sales, that's a classic sign. What's interesting is that, you know, Powell was talking about how the volume of job loss and job gain on both sides was relatively low. And I think what that says to me is that people are really focused on keeping a job, keeping income in the household. My friends at MBA, by the way, have told me that they see people prioritizing mortgage payments instead of things like car payments, which is what they did in 2008. So there's a change in the tenor of consumers, much more cautious. And I think we could see a lot of pain in terms of credit. We may not actually slip into a recession, though. That's the funny part. You may not see employment go in that kind of classical sort of way that we've seen in past recessions. So for the Fed, it's a difficult call because on the one hand, they know that there are sectors of the economy that would really benefit from low interest rates. Private equity, for example, where we have a train wreck going on with many of these portfolios that cannot be refinanced. You also, by the way, have a lot of lenders in many of these markets, what I call hard money lenders, who are typically the ones that buy assets after foreclosure. They're getting kicked around too, because whatever debt they had in 2021, which was cheap, right, is now twice as much. The rates for loans like that is 7, 8, 9%. And so when you look at that, the portfolio doesn't work anymore. There's also a lot of people who've withdrawn from many wholesale markets, a lot of banks, a lot of non-banks. The mortgage industry is shrinking dramatically. You saw that transaction with Mr. Cooper and Rocket. You're going to see more of that. The industry is going to consolidate down to 5 big lender/servicer groups, which is kind of what everybody wanted. They wanted big, muscular non-banks. That's what you're going to get. I think the markets are way ahead of the Fed. I've been watching the 10-year fall, and indeed the mortgage market too. The 5.5 Fannie for next month, which is where people are going to sell loans, is at par now. They're probably still selling loans in the 6s, but my point is they're going to be writing 6.5% loans, or 6.75%. And that's good, but the market's way ahead of the Fed. The market's been taking rates down. They blame it on Trump. But I got to tell you, I think there are a lot of other factors behind it. And every time we've gotten the 10-year up close to 5, it comes back. So I think that retracement is still what we're going to see for most of the year. I would not be surprised to see no actual changes in Fed policy this year, other than, I think, stopping the runoff of the balance sheet. It's remarkable to me how many economists will just discard the balance sheet as a factor in monetary policy. They want to talk about targets. And it's like, guys, the balance sheet on the one hand, from the Fed's perspective, and then what the Treasury is doing under Scott Bessent and the reductions in outlays that have been engineered by the Trump people, what are they doing? They're trying to reduce the size of auctions so they can force rates down. So if the street sees the Treasury is actually going to need less money in the second quarter, that wasn't the case in the first quarter, obviously. We had record deficits. That's going to start to affect rates. Because believe it or not, the collateral markets are pretty tight. Buying certain coupons right now is difficult in size. The demand for risk-free assets continues. And that's why the dollar is so popular. People can do trades in the dollar. They can get treasury securities to collateralize swaps, right? Most other currencies, you can't do that. So no matter how we screw up on the fiscal side, people seem to want to use their money. I think they can range trade depending on what's going on. You know, right now, people are risk off on stocks and other assets. They're also fleeing the carnage in private equity. So treasury securities are obviously going to be very well bid. People are looking for a place to hide. Also high quality corporates, you know, Ginnie Mae's, everything. The whole interest rate complex, I think, is going to continue to fall in terms of cost. So when people say to me, oh, Chris, you know, the Fed's going to cut rates 2 or 3 times this year, they already are. The Fed doesn't have to do anything. They just get to sit back and watch, which I think Powell would welcome right now, because the data he's seeing is all over the place. The employment data, the other data. You know, to me, if things calm down and we start doing trade deals, I think you could see rates back up. But again, remember what Bessent is trying to do. The whole point of the Trump cutbacks in Washington is to reduce the cost of government and thereby give the Treasury some breathing room in terms of how much money they have to raise for the next refunding. If the Treasury general account has more money in it than they were expecting in the second quarter, that's going to be good for rates, because this market wants paper. They want risk-free collateral for a variety of reasons. And, you know, the banks haven't been growing very much. That's taken some demand away from the market. But I think, you know, the money market funds have been growing hand over fist. They've been the big beneficiaries of the past couple of years. I think the people are looking for a place to hide right now until they figure out what the new rules are. And it's not at all clear. The media is having so much fun with this. They keep spinning all of these tales. And yet, at the end of the day, this is all about shock and awe. The Trump people are just trying to get a deal. And 18 months from now, I think people are going to be kicking themselves if they weren't looking at stocks. My banks aren't cheap. JP is 2.1 or 2 times booked this morning. That's not cheap.